Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending May 16, 2025. So the title of the review this week is Memorandums of Understanding. This is what we've had from the US over the last 10 days. It's not trade deals, it's barely outlines of deals, it's more Memorandum of Understanding with the UK and one with China, where they agree that they will be continuing to talk and you have a broad outline of what they will be talking about, but you don't really have trade deals. You've had some detente in terms of tariffs. It was very important to have that between the US and China because it was more or less an embargo between the two countries on most of trade. So this is, of course, positive development that we've seen this week. They were able to reach some kind of deal in Geneva last Saturday. Now, there's still risks to the relationship going forward, but this reset of the relationship is cheered by the markets with good reasons. Before we go into, it's allergy season here. Before we go on the update on tariffs, maybe an update on the markets this week, just focusing on equities. It's not a typo. 4.6% on the S&P 500, 6.6% for NASDAQ this week. And look on the columns on the right, year to date. S&P 500 now is back in positive territory year to date. We're still down about 4% from the peak, which was on February 19. But we're making new all-time highs on the TSX this week, making new all-time highs on EFI, so Europe and Asia. Year to date in Canadian dollar is not a typo, 10.8% for EFI, 6.8% for emerging markets, 5.8% for the TSX. It's in the US that US assets have been under some pressure. Price of gold up 23% year to date as well. We'll discuss gold in a few minutes. But looking at the update on tariffs this weekend, I think this week was very important for multiple reasons, some that are obvious and some that are not. US and China, of course, agreed to drastically roll back tariffs. That was good news. It was a surprise. No one really was expecting such a solid reset at the beginning, when we started the week on Monday. 90-day pause. So we've played this movie before in 2018 when China and the US did agree to an outline of a memorandum of understanding on the negotiation. And then, it didn't take long before the Trump administration, found some concern with with China's position or attitude, and we went back to the tariffs. And it took 2 years to reach a deal, and that deal was signed just before COVID hit. And because after that, of all of the sanitary crisis, this deal was pretty much useless in the end. So will this detente last for a while this time, or will we go back to a head-to-head conflict between the two? We'll see. But already this week, China is issuing warnings to the UK over the terms of the US trade deal. They're complaining that there are some language in there that kind of suggests that the US is trying to push the UK away from China. So there's already some cracks that are appearing here. We'll see where that goes. But the last point on the bottom right, this is from this morning. This is reported from Bloomberg that Trump says that he will set tariff rates for other nations in the next few weeks, 2 to 3 weeks. So if that sounds familiar, this is very similar to what happened on Liberation Day on April 2nd. Just reading from the notes here, because they have a lack of bandwidth to negotiate deals with every country that is lined up, and they say that about 150 countries want to make a deal. Of course, if you're representative in any country in the world and you get slapped with those tariffs, of course you'll take the phone and you say, right, can we talk about it at least? So 150 countries. It's not all of them that will receive letters, but they will be sending letters out. I'm quoting Trump here, essentially telling people what they'll be paying to do business in the United States. So, right now the market, the sentiment has shifted because we went from uncertainty in March to peak headlines in April, in beginning of April, to then after that, the famous tweet, it's time to buy, and then 90-day pause and 10% baseline on everyone. Now it seems that in the next few weeks, there'll be letters sent out to say, right, so the tariff is X, and X is very much likely to be higher than the baseline 10%. I think it's fair to expect that, or it's unlikely to be lower than the actual 10%. So will we go back to something that looks like Liberation Day light? Maybe, probably, and this of course could have a very important impact on sentiment. So again, markets have rebounded quite a bit. So if you're listening to this and you're in the crowd that said, well, I was very nervous and I was losing sleep with my portfolio in March and April, but now my portfolio has rebounded, maybe it's a good time again to talk to your financial advisor. Make sure that if there's another downturn caused by headline risks like that you're still in a position to achieve your financial goals and you're not losing sleep over the markets. So again, just this is the data that we have this morning, the news that we have. So let's see how it shapes out. Would be the first time that we hear something like this and then something else happens. Maybe now the immediate impacts of China-US. So the chart on the left here is very important. It's the departures from China to the US in terms of container ships. So as you can see on the line here, it was pretty volatile, but March and April, there was a huge spike because importers were trying to get in front of those tariffs just to build inventories. This helps with inflationary pressures down the road, of course, because you were able to purchase before the tariffs hit. But now you see the sharp drop. That means that there's less shipping from China to the US, and we went from a near total embargo to now we could see empty shelves. This is what we're hearing anecdotally from US businesses, and that could fuel inflation. Very simple things like the back to school material that is usually already ordered and shipped. We're hearing that there's delays there. So maybe back to school this year will be difficult in the US to get the supplies. Christmas ornaments, I know it's only May here, but usually those orders are in and they're shipped during the summer for the shelves to be full by the fall and early winter. Well, mostly the fall here, but now we're hearing that there's massive delays and almost no orders there. So this is how inflationary pressures can happen. And this week we had a very important announcement from Walmart saying that, well, they cannot hold off hiking prices forever, and they're flagging that they will start hiking prices at the end of May. And when the big guys like Walmart and the Home Depots of this world start hiking prices, the floodgates open. Because let's say you're a small hardware store, in a local hardware store somewhere in the US, and you sell hammers and you sell any building material that the other guys sell as well. Well, likely you import from similar places, and if the price rises or if you have a tariff that comes in this case here, well, you cannot just pass it on to the consumers if the Walmarts and Home Depots of this world don't, because you're just going to be losing business to the big guys and you'll be out of business. So when the big guys, with all of the logistics advantages that they have and their ability to support, higher costs for a while, when those stores start to pass on costs, then it just floodgates open for everyone to start hiking their prices. And this is how inflationary pressures happen. So are we about to see inflation pick up? Well, this suggests that we're getting closer and closer. And the second point here on the right, slower shipments potentially causing temporary job losses in retail, in trucking, in transportation, so everything that has to do with the logistics of commerce. So maybe we could see some impacts on the jobs report, on inflation report starting to happen very soon. So the impact on soft data is evident on surveys, but on hard data maybe is just around the corner. Now turning to Canada now, housing market is showing signs of life. On the left you have housing starts, volatile series, but we've had an appreciation of 60% over the last month, so there's some life here. Of course, can be volatile, but it's kind of confirmed with the chart that you have on the right, where housing prices in the main cities, you have Toronto on top, then Vancouver, and then you have Montreal, Calgary, Quebec City, Ontario. So you see in all of those, it's not Toronto, it's not Vancouver, it's more elsewhere in the country where we're seeing prices rise. And it has a lot to do with demography. So we've had a solid demography shock over the last few years. Of course, if you come from another country, you tend to go to the larger centers, so Toronto and Vancouver, maybe Montreal, but because of the language barrier, it's less likely. And then after that, once you're in Toronto for a year, 2 years, 3 years, well, housing is expensive, economic opportunities, maybe there are some that are more interesting elsewhere in the country, and then you have a diffusion of population, and this is what we're seeing now. So this is pushing, of course, housing prices higher, which has, of course, an impact on inequality and generational inequality and all of this, but it does create some economic tailwinds with more construction, more housing starts, more purchases of houses, buying furniture and all of that. So it does bring some an economic tailwind to the country. So good news here on the macro side. Finally, for the markets, investors are buying gold and European stocks in 2025. So year to date, the flows on the left, you have gold, on the right, you have European stocks. As you can see, for gold, it's the highest by far if you look at the last 10 years. And for Europe, it's the best annual flow in 10 years. So one theme that we were discussing late 2024, early 2025 is that with US equities being this expensive and other markets being less expensive, geographical diversification was key, and diversifying through different asset classes was key. Well, the market has done that this year, buying lots of European stocks, lots of gold. But now the consequence is that, if we go to the next slide here, that those trades have become crowded. Now, according to Bank of America fund manager survey, institutional managers saying that long gold, so buying gold, is the most crowded trade by far. After that, Magnificent Seven is still in there, but after that, it's long European stocks. So is there still upside on those trades? Likely, yes. But is there as much upside as at the beginning of the year? Maybe not, because now those trades have become crowded. So we're looking at all of our scenarios until the end of the year. We're working on the next monthly. The bull case that we have is that the US stock market could be going sideways with some volatility. The base case is that maybe we retest the lows because of the headline risk that I was discussing earlier. Bear case, maybe we can go into bear market. This is based on the information that we have now. If we have a complete turnaround on policy in the next few days, then we will be changing our mood. But based on the info that we have now, this is what we see. So investing elsewhere around the world in other asset classes continues to make sense. So what we'll be watching next week in Canada, we'll have CPI inflation, 0.5% month over month. Seems huge, but this is not deseasonalized or seasonally adjusted. In April, there's a lot of products or services that kind of reset their prices, that have price hikes. So historically, April is a high inflation month. You have 0.4% on average, so that would be a bit hotter than usual, but year over year, 2.3%. So I think you're still in a good spot for the Bank of Canada to cut once more in June. CFIB business barometer, so a very important indicator of small businesses, how the sentiment of those owners, and retail sales. And in the US, global PMIs, existing home sales, new home sales, building permits. We're not seeing that much contribution to growth coming from housing in the US. So let's see how data is faring this time around. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content here, please share, and of course, come back again next week.